Good afternoon and welcome to this ACT webinar on balancing the management of currency and interest rate risk for the organisation. I'm James Lockyer, chairing the webinar for the ACT. I'll quickly explain some technical points about our webinar setup before we start. There's a menu bar across the bottom that allows you to open various windows. You can move these around your screen, resize them or minimise them. The yellow button with a question mark is to help if you have any technical difficulties. And the purple Q&A widget opens a new window. You can send questions to us by typing in the window. Please don't wait until the end to send in your questions. Send them in as they occur to you, and we'll deal with them at the end of the presentations. And we won't disclose any names. I should add that a recording of this webinar will be available on the ACT website in 2 days' time, along with a separate copy of all the slides. We're delighted to have speakers from Chatham Financial and CRH who have lots of experience with the practicalities of developing integrated approaches to currency and interest rate risk. Chatham Financial has sponsored today's webinar, so on behalf of the ACT, can I thank them for that support.
Thank you. Thank you for having us.
In a world where risk is increasingly risky, yet arguably sourcing the credit and capacity to support financial risk management is increasingly challenging, it's vital for corporates to maximise the efficiency and effectiveness of risk management activity. So to give us some insights into the challenges and opportunities of balancing risk management priorities are Paolo, who's Executive Director at Chatham Financial, responsible for Chatham's corporate advisory team in Europe, advising corporates, private equity funds on how to structure and implement financial risk management programs. And also Colin O'Gorman, Treasury Manager at CRH Group. Colin works in CRH Group Treasury based in Dublin, joined CRH in 1998, and his recent experience includes debt capital market influences and hedging strategy and implementation. After the presentation, we'll finish with a discussion and as many of your questions as we can get through. So, without more ado, Paolo, handing over to you.
Thank you very much, James. So, today we'll be talking about risk management. We'll see what generates interest rate and currency risk and what tools are available to treasurers. And we'll discuss some of the approaches that we have seen our clients take, while Colin will share how CRH approaches these risk management decisions on the available tools. But before we start, just allow me to do a 2-minute introduction on Chatham Financial. So, Chatham is a company that focuses on providing advisory and technology solutions for risk management, specifically on the areas of interest rate, currency, commodity, and inflation. We are structured in sector practices, supporting roughly 1,800 clients globally. And from the corporate sector, we work with some of the largest global companies, but also with many smaller ones. We have practices that address the needs of private equity and real estate funds and also financial institutions. On the bottom corner, on the right of the slide, we have some statistics. We structure and execute derivatives for approximately $500 billion every year, and our system produces 30 million valuations and 1 million of journal entries for hedge accounting every year. The next slide, we just look briefly at the services that we provide specifically to corporate treasuries. We do advise companies on how to manage their financial risks. We support them in assessing their exposures, quantifying the risk, and in defining the hedging programs that are in line with their objectives. In many cases, we end up executing the derivative transactions on behalf of our clients, as we are experts in derivatives and in negotiating fair terms with the banks. We then have practices that provide advisory in legal and regulatory compliance, navigating the complexity of EMIR, for example, or ISDA negotiations. And finally, we have valuations and hedge accounting services that are provided through our system, Chatham Direct, and they are supported at the same time by our in-house hedge accounting expert. And we serve in that area roughly 500 clients in order to allow them to apply hedge accounting under IFRS and US GAAP. So, moving into this webinar, we want to look at ways of dealing with interest rate and currency in a combined way. what decisions can company take that affect both interest rate and FX risk profile, in which occasions is this relevant, and what tools are available to corporates to address these two risks, or also what are the implications of addressing one risk on the other. So to start, in this slide we find some of the topics that we are currently discussing with our corporate clients. In the past few years, currencies have been volatile, it's not a surprise, and since the beginning of the year, the euro has been reversing the downward trend versus the US dollar. This meant that many companies had to reassess the strategies that they had implemented in the past couple of years. And considering that the fate of the pound is still very uncertain, currency is still on top of the mind of our clients. Our clients want also to know how to think about funding and the implication on currency and interest rate risk. Do the markets present some interesting opportunities to fund debt at lower levels? And clients approach us asking, my banks are suggesting to enter into cross-currency swap to reduce the cost of my borrowing. How does that work? What should I do? Other typical and common questions are, should I lock in the low rates now, considering that the forward curve is upward sloping, but still at historically low levels? And obviously now there are concerns over rates rising in the future. So because of that, we've seen many companies starting to do more pre-hedging. And with the UK inflation ticking higher, just this week from 2.6 to 2.9, there are questions on how the Bank of England will react. So with LIBOR already seeing some increases in the past few weeks. Finally, touching on accounting standards very quickly, there are different strategies that will become more or less favorable from an hedge accounting standpoint, and there are significant changes to come on hedge accounting for cross-currency swaps. So these are just some of the current topics that we see our treasurers discussing, and in our usual discussion on how to manage risk, we have previously looked at interest rate and currency programs separately. So you could make reference to the webinars that we have done together with the ACT in the past, with companies, co-speakers, Essential and Vimpelcom. So we have looked at ways of addressing FX risk through operational hedging programs, from understanding the company's risk management objectives to structuring and then implementing the program. On interest rates, we have looked at how to model the interest rate risk and how the interest rate hedging practices have to change recently to address the evolving market dynamics. And while FX risk is typically handled by Treasury, the decisions on interest rate risk management don't always sit with Treasury. Particularly because of the interactions between these two risks, there is an argument here that Treasury should be involved in the decision on interest rate risk management too. So today in this webinar, we really want to see when a company can address these two risks together. Situation in which interest rate and currency come together, for example, is when making decisions on the currency of funding, because a decision on the debt side will have an impact on the FX risk profile. Typical questions that we receive from corporates are, how can we lower the cost of funding by looking at different sources? How can we analyze the comparative prices of debt in different currencies? So when choosing a capital structure, there are two main approaches. Companies that have funding capacity in different markets, these companies could raise debt naturally, say in US dollar. Other companies that will not manage to do this have instead the choice of changing the currency of their debt in a synthetical way using cross-currency swap. And we've seen that the drivers of these choices are two. On one hand, it's purely for risk management considerations, because the interest rate coupons on the foreign debt can be used to offset the positive cash flows that are generated by the business in that currency, and also because the final principal payment of the foreign debt can act as a hedge of investors' equity. The second driver instead might be purely economic, because natural or synthetic funding, as we will see later on, could actually work out to be cheaper. But let's see these two approaches in more detail. On the natural side, a typical debt denomination scenario is when a company has business in various currencies. Here we see a UK-based company that, if you look at the top right corner, has 70% of the gross profit generated in euro, with 10% in other currencies and only 20% in pounds. So should this company put debt in any other currency? How much? We put three choices in the slide. The first is having all debt in pounds, which is the easiest solution for a UK company. But this would not generate any offset between the positive euro cash flows generated by the business and negative cash flows for servicing the debt. So there could be some mismatches there that can hurt the bottom line on the cash flows if not addressed. Alternatively, the same company could place some debt in euro, and this would address the biggest exposure, as we say, generating negative cash flows in euro that offset the positive euro cash flows produced by the business, and this effectively reduces risk. The third alternative is for the company to match the debt with the exact composition of the gross profit, and some companies really care about having a similar leverage ratio across different business units, as this can affect the credit rating in different geographies. But what we usually see is a combination between the second and the third approach. The benefits of the second is that it's still relatively simple to implement. It would reduce the overall level of risk due to currencies, stabilizing the cash flows of the operating profit, for example, and could also help reducing the risk of breaching covenants, as some covenants are structured around net debt to EBITDA ratio or some covenants around assets. The second way for companies that cannot tap funding in different currencies and might have some liquidity limitation and constraints is to look into synthetically converting debt from one currency to another through a cross-currency swap. We mentioned that it can be useful to match the currency exposure to produce beneficial offset between opposite cash flows in the same way, but let's look also at when this can bring a comparative advantage on the funding cost. So, how does the cross-currency swap work? Imagine a company that ultimately needs euro funding. This company can raise debt in US dollar, for example, and execute a cross-currency swap. The cross-currency swap will convert the proceeds from US dollar to euro, and with regards to the coupons, it offsets the interest payment in US dollar and replaces them with interest payments in euro. The same happens for the capital payment at the end of the maturity. That is an optional payment, but most of the time we see that there is a final exchange. As a result, the company ends up with euro coupon payments to make and with euro capital to repay, just like if it had a euro-denominated loan. And let's look at now how to assess this choice from an economic standpoint. Let's assume that the company can borrow naturally a US dollar LIBOR plus 300 or naturally in euro a Euribor plus 300, so the same margin across these two currencies. At current levels, the company would have all-in cost of 4.8 in the US dollar case and of 3.05 in the euro case. This is a prevailing market rate, and this is also because the euro rates are lower. However, instead of doing this directly by issuing in euro, it could be done synthetically. The company could issue that in dollar, convert it in euro through a cross-currency swap. And because of how the cross-currency swaps are priced currently in the market, this would bring savings. You can see that on the right-hand side of the slide. Savings of roughly 50 basis points, lowering the cost from 3.05, which is the natural cost of euro debt, to 2.55, which is the cost of a synthetic euro debt. And this, on, let's say, a 500 million euro debt with 5 years of maturity, this 50 basis points mean lower interest expense in the amount of 12.5 million euros. So that can be significant. Why is this happening? This is because in addition to having lower rates in euro compared to dollar, so in addition to the interest rate differential, it's because there is currently a positive cross-currency basis. And the cross-currency basis is a market component that enters into the pricing of cross-currency swaps. It can be positive or negative. Currently, from dollar to euro is beneficial in the region of 35 basis points on a 5-year period. But over the time it moved up or down quite a lot. It went up to levels of 65, for example. So the possibility of using cross-currency swaps to reduce the cost of debt are significant and should not be underestimated. So now that we covered the basics, Colin will talk about how CRH approaches these choices on interest rate and currency.
Paolo. Just some brief background anyway on CRH. It's a diversified global international building materials group where the majority of the sales are in the US, and we also have the next largest exposure then is in Europe. Our products are generally in low value and heavy and are relatively costly to transport. And typically what we see there is that if something is for sales that happen in the US, we would have costs, or if the cost base is in the US, is in US dollars. So that's the typical kind of natural hedges that we have in place. Our credit rating, we are investment grade rated, BBB plus Baa1 by the investment agencies. And generally speaking, for our currency exposure, we have little by way of transaction exposure, but our largest exposure is on the translation exposure. We're headquartered in Dublin, and for reporting purposes, our reporting currency is in euro, but obviously we have exposures to, as I said before, the US dollars and other currencies as well. And for our interest rate exposures, we have the majority of our debt is in the form of fixed rate bond issues in a variety of currencies, and for each of those bond issues we would always tend to seek the long tenors. In terms of our strategy, we would look to balance the spread of net debt by currency and our net worth by currency. Another strategy for us that has been key is to maintain a comfortable interest cover and also to maintain our financial strength and flexibility. Obviously for the operations, their focus is on performance and cash flow, and for our treasury centre is a cost centre, so we don't really look to gamble, let's say, or speculate on markets. So we will deal with what we have in terms of our net worth exposures. Brief overview at the year end, with 15 bonds in issue. That's a total of 7.4 billion in euro, and that's a variety of currencies between euro, dollar, sterling, and Swiss issues, and the maturity range then is from 2018 out to 2047. We've been issuing in the public markets since 2002. That's when we did our first public issue, and we've also had private placements in the past as well. Just to give you an idea in terms of the maturity profile, we've got approximately 4.6 billion maturities, and they occur beyond 2021. And in terms of spacing of those, we like to have those spaced out with no bulky maturities in any one particular year. In terms of our credit metrics, for 2016, our EBITDA to net interest was 9.9 times, so that's a very comfortable level for us. Our stated absolute base level was 6.5 times, and we have covenants as well are 4.5 times. The debt metrics in terms of net debt to EBITDA, we have a 1.7 times coverage there at the end of 2016. It was 3 times in 2015, and that's just due to acquisitions that were made in 2015. And as I say, one of the key operational efficiencies that we look to is to have a strong cash flow, so we can sort of see the impact of the cash flow, a strong cash flow in 2016, and the impact on the net debt to EBITDA. Again, just to reiterate about the credit ratings, we would strong credit ratings, and we would one of the key strategies for us really is to maintain an investment grade credit rating. In terms of gross debt, so just for the year end, as we go through the slides, just be conscious that the actual total net value of our derivatives at the year end was quite small, but So we had 7.7 billion in gross debt, cash to 2.4 billion at the year end, giving us a net debt of 5.3 billion. Of our fixed rate instruments, we've swapped about 1.6 billion of those to floating, and that's across a mix of currencies that we have. Most of our interest rate swaps are in dollar and in euro. Traditionally, certainly in the past, we've looked at to balance that in terms of 50-50, but in the last number of years, we have been more fixed than floating. And also the principal value of our currency swaps, total 1.6 billion as well. Our strategy in terms of managing the interest rate risk and the currency risk is when we look at our net worth by currency and our net debt by currency, and to have a good spread across our balance sheet by currency. Now, in terms of the slides, I suppose some of these points here might fit in better once we go onto the slides, but just in terms of to give you an idea of the size of the balance sheet, we had 4 billion in trade receivables, 5 billion in trade payables at the year end, and there's a cash generated from operations of around about 3 billion for the year. In terms of hedging, I suppose the point when we're looking at our debt issuances, whether if we're looking at the dollar market or the euro market or any other market, we would consider cross-currency swaps. As I say, we always would like to keep in mind what the alternatives are, and one of the key things for us is that since we've been in the public bond market since 2002, we would look to once we've built up the curve in dollar or euro issues, we would seek to maintain that balance and those exposures to those debt markets. So overall, in summary, then for just looking at this slide here, it's a summary that you see in our 2016 annual report in Form 20F. We've just sort of put it more in percentages. You can see our cash and debt of 5.3 billion there, and that's broken out by currency, and overall that's our swapped. You can see that the spread of currencies across our swaps, and that in the end is just giving us a net debt position there of 5.3 billion. Just to give you an idea of the effect of the currency swaps has in our overall positions, you can see that there is a line there, net debt percentage by currency before we've placed our swaps, and also once you overlay the currency swap positions, and once you compare that then to the bottom line, which is the net assets percentage by currency, you can see the impact of the currency swaps has once you compare it by currency to the net assets by currency. And then finally, for me, I think really just the last slide just kind of gives an overall summary in terms of our percentages and our weighted average fixed period in years. You can see the total amount of our fixed rate debt, which I referred to earlier, 7.4 billion. That amount then swapped into floating, and that gives us a net fixed rate debt of 5.8 billion. And then once you add on some floating rate debt, some adjustments, some fair value adjustments, and also then the impact of the currency floating rate, gives us an overall percentage of 4.1% on a gross debt level of 7.7 billion for the group at the year end. And as I say, we have always tended to when we look at the bond markets, to seek the longest tenors possible, and you can see we have a weighted average fixed period there in years of 8.7 years. And that's me done.
Brilliant. Thank you very much. To add. Great. Thank you very much, Colin. So, if we could go next slide. We have introduced the concept of operational hedging and capital structure hedging. But the question is, when would a company choose one over the other? What are the implications of this choice? We see that there are many considerations, and in these slides we try to summarize the major ones. capital structure hedging is usually more suitable to address exposures that are stable and for the longer term. Why is this? If the exposures change over time, it would be very expensive to adjust the structure, the notional of a cross-currency swap, as this would generate settlement, cash flows, and a lot of execution costs, like it's always the case when you are executing, terminating, or restructuring a derivative. On the other hand, operational hedging is a more suitable choice when some flexibility is required, and that is because it allows to adapt to changing profile of exposures. Think about operational hedging rolling program, whereby you would adjust the hedges as you go along, as you have more visibility over the future exposures. So the next slide is one that we want to use to show what a program can achieve or not achieve, and how the comparative benefits of one versus the other are. So in our conversations with clients, we usually find that a good place to start is to talk about priorities and risk management objectives. What does the company care the most about? And what does it want to achieve through its risk management program? Because a program that minimizes risk on the cash flow might not be the ideal program for net income risk reduction. So we see that every company is different. It might be because of the ownership structure, and we see that public companies will care about stabilizing the net income or the earnings per share, while we see that private companies will care more about EBITDA. And priorities can also depend on future plans. For example, plans to divest part of the business. In that case, it might make sense to pay attention to stabilizing the equity value, reducing the volatility on the net investment. Also, we've seen some companies caring about EVA, the economic value added, which is a very different measure from the accounting results. So it becomes very important to understand how, in this context, for example, realized and unrealized gains and losses for derivatives are accounted in the specific company. The same goes for the actual definition of EBITDA. What is it captured by it, what is not? And this actual definition will have an impact on what the programs work to reduce EBITDA volatility, or, for example, what programs work to reduce the volatility on covenants. And so looking into what doesn't go into the EBITDA is something that we can help with. And in our experience, we have seen that different industries might have different priorities. So there are companies that work in capital-intensive sectors. They will want to look at the risk at the CapEx expenditure level, which is usually outside of the EBITDA. So other companies instead might be very sensitive to hedge accounting and to how those choices on risk management are reflected on the statement. Therefore, we will need to look into how to make the capital structure hedging or the operational hedging program work from an hedge accounting standpoint. And there are nuances in that. And with this, I have covered the material that I wanted to cover. So I leave it to James. There are questions coming in.
Oh, thanks, Paolo. I mean, there's a hell of a lot there. I think a couple of questions. I think the first one, which actually came in prior to the session, which is worthwhile looking at. We had a question on when is it either appropriate or best recommended to enter into a balance sheet hedging program, which we thought actually was a really good question to kick off with. I think Colin has got a couple of thoughts on that, and Paolo is going to follow up.
Sure. Thank you. In terms of how we look at it, it can be a number of different. It can be transactional, really. So in terms of if there is an acquisition that occurs in the currency where we don't have a debt position already, or in fact if we do take on an acquisition already in a currency that we already hedge, we would seek to rebalance. We seek to rebalance that when it happens. But of course, in terms of when you look at the network by currency, it's monitored regularly. So obviously, today's presentation was based on year-end 16 and on the currency balance there. But of course, just through normal, monthly management accounting, you can sort of see the progression and the impact of EBITDA on net worth and during the course of the year.
Out of interest, do you go as far as to either budget or as part of the strat plan process sort of look at the currency mix of your assets and liabilities going forward and sort of just build that into your overall strategy?
Yes, absolutely. Yeah, we do look at that. Certainly in terms of, we would, for the coming years, in terms of we would look at how we forecast and how we see the year end 2017 coming up, and also 2018 once we head into a budget period. And that all depends on cash flow by cash flow forecast. We look at cash flows by currency. So that's one of the key things that we do look at. So in terms of that's an ongoing monitoring between the general, between monthly management accounts and the budget process.
Sure.
So the strategic plans as well.
Yeah. Cool.
If I can add on this point, we feel that also there is, on the question of timing, there is a component of expectations, and with concerns over Bank of England rising rates just these days, or just because of the perceived volatility and the risk that is perceived, we've seen loads of companies that have started executing more pre-hedging effectively, and this could be the case of future acquisitions, but also on future refinancing. And when we're looking at this specific case of future refinancing, the derivative solutions that are typically looked at are, for example, forward starting swaps or swaptions. These can be very useful and very effective. Obviously, we'll want to look exactly into how they are priced, or execution and credit charges are there. There are nuances there, as there are nuances in how they are accounted. But definitely there are solutions for addressing timing concerns.
Sure, thanks. We've had 2 or 3 other questions partly around the fixed to floating mix, particularly for CRH, but also around sort of investor expectations. And I know you're listed on 3 exchanges. You've got a variety of bondholders, debt investors, you've got a variety of equity investors. And I was just wondering, the specific question on interest rate mix was, do you think 50% is about right for the business? But I think the wider question is sort of, what do investors expect from CRH in its funding hedging strategy? And how do you make sure that communication line stays open and that they understand what you're doing and why? There's probably 1,000 questions in there.
Well, I'll go through it. In terms of the 50-50 mix, we would certainly in the past have targeted 50-50 mix. Naturally, you're not always going to get it exactly right, but certainly in the last number of years, we have certainly seen ourselves go more fixed than floating. That is just a matter of the economic cycles that we've seen in the last few years. So I'd say that is something that can change. We're not absolutely determined to keep it all fixed. I think that just depends on how we see the economies improving over the years. And then, let's say, if we're looking at a rising interest rate environment, then it is something that we would look at in terms of having a greater amount swapped to floating.
Can I add a perspective that we see? This is usually a question that we always address when working with a client of ours that is going through, let's say, new financing and wants to discuss how should they think about what's the appropriate fixed to floating mix. And there are many components. Some of those are more quantitative, others are qualitative. Surely some of the things to consider, I will only name a few. It makes sense for the company to understand how its business is correlated to the underlying rates. So businesses that are more or less correlated would see the impact of the interest rate having an effect on the bottom line that might drive them to go either towards more fixing or more floating ratio. Other aspects are the leverage ratio, with companies that are more leveraged, usually wanting to take a more fixed approach to have better visibility over a significant component of the P&L. Other companies purely look at what is the interest expense risk that I have. If rates move by plus 50 or minus 50, how can my business sustain that? Other things are around comparison with peers or how stable the costs and revenues are. So what we're trying to say here is that there is not a scientific way to address that question, but looking at a combination of quantitative analysis and qualitative aspects and qualitative analysis of how the company reacts to the underlying rates is probably the best approach.
Sure. We had a couple of other questions as again. I might just bring together. There's a question about any regulatory aspects that overlay CRH's hedging program, and you've alluded to sort of rating and credit considerations as well. And I think sort of almost with that, sort of on the, if you like, the official envelope within which one hedges. Paolo, you remarked earlier about changes in the accounting treatment of derivatives. I don't know whether it's worth. How do you want to lead on that one?
Indeed. So there are upcoming changes. IFRS 9 is the major one, and this is really our topic now because we have discussed quite a lot today about cross-currency swaps, and cross-currency swaps are going to be affected significantly by the upcoming changes. So, in a nutshell, cross-currency swaps are a credit-intensive instrument. We have seen that very often there is a final exchange on these structures. That makes the requirement to look into the credit valuation adjustment, CVA and DVA, that is mandatory under IFRS 13, is likely to have a material impact on the accounting. So that is something that will really need to be done. Additionally, the IFRS 9 brings a lot of complexity on cross-currency swaps. In a nutshell, companies will need to capture the cross-currency basis at inception, but also over the life of the hedge. And this is really complex from an analytical point of view, step to take. And we're seeing that all the companies that we work with are not really ready for that yet. So indeed, some changes in accounting and regulation, there is another topic, are definitely increasing the complexity for corporates in the compliance space.
Sure. And sorry, and also Colin, on the regulatory side, do you find there is an on-cost, either a sort of operational on-cost or even a capacity constraint around what you're able to do as opposed to what you'd like to do due to regulation, or are you relatively okay?
Certainly, if we're talking about regulation, and I have to talk to Paolo's point about it, the IAS 39, IFRS 9 switch. One of the things that we would always seek when we are looking to put in place either a floating rate interest rate swap or a cross-currency swap or an FX swap is, can you get hedge accounting for it? Because that is one of the things that we would look to do is to ensure that you disable P&L volatility. And one of the key things is, yes, we do like to use the hedging and use the hedging instruments, but one of the key considerations also is can you get hedge accounting first? Sure. What you don't want to do is introduce, P&L volatility, and I suppose effectively IAS 39 for what we do, it works for IFRS 9. It's a different standard in certain respects. And I certainly think that it opens up greater possibilities, really more on the commodity side.
Sure. Paolo, you have some thoughts as well.
Yeah, maybe another side to that is the proper regulatory compliance, thinking about EMIR and Dodd-Frank. And what people have come to realize is that nowadays there is not an unregulated derivative. What we mean with that is every time a company, even an end user like a corporate, enters into a derivative transactions, there are a set of requirements for them. And naming the three major ones, there is timely confirmation obligations, there is portfolio reconciliation, there is reporting. So This brings a compliance angle. How should the company become compliant with that regulation? What documentation needs to be put in place? Does this need to be negotiated with a bank, or is it a standard set of documents that is put in place? But there is also an operational angle. So how do companies effectively operationalize this compliance with EMIR? Do the company delegate the reporting to their banks? Should they delegate it to a third party? Should they do it in-house? So there is a lot of additional complexity for complying with the regulation, and that is evolving as well. So
yeah, but I think a lot of that is now systemized, isn't it?
It's a question for Colin, I would say. We have our view.
I think a lot of it is based off systems. You can self-report, and then there are the third-party providers as well.
Indeed.
As I say, it is a complex area in terms of mere reporting, and of course we also have Dodd-Frank reporting as well to do.
Yeah, and we have some visibility on that, James. Chatham is the largest third-party reporter to BTCC, which is a trade repository.
Yeah.
So we have some visibility over what the market does. We see that also large companies do not go through the pain and the cost of setting up their infrastructure in order to report directly. So when they don't want to rely on their banks to report on their behalf, they need... Yeah, exactly, that's correct. Because the only thing that needs to be taken into account here is that even when a company instructs the bank to report on their behalf, the company is still responsible for what is reported.
Sure.
So there is a factor of visibility over what's reported and that risk.
Yeah. But I think the interesting thing, sort of judging from your presentation, Colin, is that actually you are able to hedge what you want operationally and just in getting the job done. So it's not as if regulation or the regulatory environment is necessarily holding that back.
No, it hasn't really. And in terms of what we wanted to do in the past, whether it be either looking at bond issues in a variety of currencies or our interest rate swaps or cross-currency swaps, yes, I think we've been able to manage to execute what we wanted to execute and achieve the hedge accounting in terms of one, reducing that P&L volatility and also achieving that net debt and that balance of currencies.
Brilliant.
Maybe a question for Colin.
Very, very quick.
Very quick. Companies that take the approach of, I will do the hedge that makes economically most sense, and I will deal with the accounting consequences on a second stage. Other companies that instead are so focused on the accounting representation of their choices that would prioritize that angle and not do a hedge that makes economic sense because of the representation on the accounting. I don't know if you have a house view on this.
Well, I suppose if we are looking to achieve a position, yes, I think we will obviously we'll do our best or endeavour our best to try and achieve the hedge accounting. I think if we don't, I think maybe that's something that, for whatever reason, it's maybe something that we would flag to our investors in terms of if it's something that we couldn't achieve, but I think it's something that we've been managing to achieve so far. But as I say, if that happens, I think that's something that's just down to investor communication, and it's the same with any other type of investor communication. We were talking about it earlier on in terms of how we talk to our equity investors and how we talk to our debt investors. It's in fact very similar and very the exact same stories, and just really for our debt investors, there's just that little bit more detail about commitment to credit rating, looking at our credit metrics and our debt metrics, and that's something obviously that debt investors focus on, whereas the equity investors maybe perhaps more focus on the balance of the business.
Brilliant. Okay, thanks very much. I think the time has come to wrap up. Firstly, my thanks to Colin, CRH, Chatham Financial, Paro, for your support. I'd like also to thank everyone who joined today's session. I'm sorry if we didn't reach your question in time, but as I mentioned at the start, a recording of this webinar will be uploaded on the ACT website along with the presentations in 2 days' time, and we will send you the link. Just very quickly looking forward to the rest of the year, we have the Asia Forum in Hong Kong in a couple of weeks' time. There's the Middle East Annual Summit in Dubai at the end of November, and of course between those, the Forum and Annual Dinner at the start of November. Thank you very much for listening. If you could spare a moment to provide feedback on the webinar, we'd be very grateful. Please select the feedback widget in green at the bottom, and the facility to do this will remain open for a short while after the webinar ends. Thank you and goodbye.
Thank you.